Hey, listen. Imagine a company that doesn't manufacture ordinary nuts and bolts but tiny precious engineered metal components that go inside aircraft engines, surgical instruments, electrical vehicles, defense equipment, and even premium consumer electronics. Here's where it's get interesting. More than 75% of this company's revenue comes from international markets, and its annual revenue has already crossed 4,100 crores, and now it's coming to the stock market with its IPO. But the big question is this a hidden manufacturing gem that could create long term wealth, or is there something inside the red herring prospect that investors should worry about? Well, I spent hours going through the RHP, and in this video, I will explain everything in simple language from the business model and financial to the strengths, risk, valuation, and finally, whether this IPO deserves a place on your watch list. So, stay with me till the end because one important risk could completely change your investment decision. Your money deserves better decisions. This is Paisa Matters. Learn smart, invest smarter. Let's first understand the IPO itself. The IPO is scheduled to open on 23rd of July and will close on the 27th of July. While anchor investors will place their bids a day earlier, now here's something every IPO investor should know. This issue has two parts, a fresh issue and an offer for sale. The company plans to raise fresh capital through the fresh issue, which means that money goes directly into the business for its future growth. On the other hand, the offer for sale is different. Here, the money doesn't go to the company, it goes to the existing shareholders who are selling part of their stake. You will notice that some early investors are partially existing through the IPO. Now, don't misunderstand this. An early investor selling a portion of their shares after holding them for years is not unusual. It often reflects portfolio management rather than a lack of confidence in the company. The shares will be listed on both NSE and BSE after the IPO. Let's understand why this company is different from a typical manufacturing business. Most engineering companies manufacture components by cutting, forging, or machining metal. INDO-MIM takes a completely different approach using a technology called metal injection molding or MIM. Sounds technical, let me simplify it. Imagine combining the precision of plastic injection molding with the strength of metal. Verify fine metal powder is mixed with special blenders to create a feedstock. This mixture is injected into specially designed molds just like molten plastic. Later, the binder are removed and the part is heated at extremely high temperatures until it becomes a dense, high-strength metal component. The result, extremely precious and complex part of that difficult or sometimes impossible to produce using traditional manufacturing methods. That's exactly why industry like aerospace, medical devices, defense, automotive, and consumer electronics rely on this technology. And here's the biggest advantage. Developing the expertise takes years. It requires advanced manufacturing capabilities, strict quality standards, and significant investments. In other words, this is not a business where new competitors can enter overnight. Here's another reason why investors are paying attention. Indo-MIM is not just serving Indian customers, it's global manufacturing company with operations extending into the United States and Mexico. Its products are supplied to customers across multiple continents. If you look at the revenue mix, nearly three-fourths of the company's income comes from the exports. Now, North America contributes the largest share, followed by Europe, while India accounts for the remaining portion. This tells us two important things. The positive side is that company has proved can compete in international markets, but the flip side is that global demand exchanges, rates, and overseas economic conditions can significantly influence its business. Alright, now comes the section every serious investor should focus on, the financials, because no matter how exciting the business sounds, the number must support the story. The company has reported strong revenue growth over the last three financial years. Its revenue has steadily increased, showing healthy business expansion, and that's encouraging because consistent growth is usually a sign that demand for the company's product is increasing. But as an investor, we shouldn't shop at revenue alone. We also need to ask, is this business model is profitable or margin improving? Is cash flow healthy? Can this growth continue over the next 5 to 10 years? Another positive point is diversification. Instead of depending on a single industry, the company supplies multiple sectors like aerospace, medical, defense, automotive, and electronics. This diversification reduces dependence on any one market. Now, Pay close attention because this is the section many investors ignores and sometimes regret later. Let's talk about the risk. The first risk is raw material dependence. A significant portion of the company's raw material is imported from countries such as China, Japan, Germany, and the United Kingdom. If the metal powder prices rises sharply, supply chain gets disrupted or currency movements becomes unfavorable, profit margins could come under pressure. The second risk is export dependence. Since most of the company's revenue comes from overseas market, any slowdown in major economies like the United States or Europe could impact future demands. The third, geopolitical and trade policy risk. Any increase in import duties or changes in international trade policy could affect the company's competitiveness. Fourth one is customer orders. Many orders are received through purchase orders or rolling forecast rather than long-term guaranteed contracts. And finally, customer concentration. A relatively small number of customers contribute a meaningful portion of revenue, so losing a few key accounts could affect business performance. Now, let's balance those risks with company strength. The first strength is its niche manufacturing technology, which creates high entry barrier. Second, long-standing relationship with global customers. Third, exposure to high growth industries such as aerospace, healthcare, defense, and electrical vehicle. Fourth, strong revenue growth supported by increasing exports. And finally, technology-driven manufacturing generally commands better margins than conventional engineering businesses. So, what's my overall view? From a business perspective, INDO-MIM appears to be high quality manufacturing company operating in a niche segment with a strong global demand and meaningful entry barrier. The company has demonstrated solid growth and built relationship with customers across multiple industries. However, investing is not only about buying a good business, it's about buying a good business at the right price. That's why before making any investment decision, I would carefully evaluate the IPO valuation once the final price band is announced. We will compare it with a listed base, analyze valuation multiple times, and study profitability ratios and check whether the asking price leaves enough. If the valuation is reasonable, this IPO could become one of the more interesting manufacturing opportunity of this year. But remember, never invest based on only on the story. Always compare the quality of the business with the price you are being asked to pay. Now, I would love to hear from you. Are you planning to apply for the Indo-MIM IPO or will you wait until after listing? Let me know your thoughts in the comment below. If you found this detailed RHP analysis useful, don't forget to like this video, subscribe to Paisa Matters and press the bell icon so you never miss our in-depth IPO reviews and stock market research. Thank you for watching and I will see you in the next IPO analysis.